Okay, let's just state the obvious. AI is the biggest story in tech, in finance, maybe in the world right now. We are smack in the middle of a full-blown AI explosion. But what are we actually looking at here? Is this the beginning of a genuine new era? A whole new revolution? Or are we just watching the biggest, most spectacular financial bubble in history inflate right in front of our faces? Let's get into it.
You gotta love this quote, right? I mean, this just perfectly captures the moment we're in. The hype has officially gone mainstream. When the guy who, hasn't updated his browser in a decade is suddenly giving you hot stock tips on AI, you really have to start asking some serious questions. This isn't just a Silicon Valley thing anymore. It's a neighborhood barbecue conversation. And that is usually when things get interesting and maybe a little dangerous.
So, let's go from the neighborhood gossip to something astronomical. Because the money flooding into AI isn't just a trickle, it's an absolute tidal wave. We are talking about a number so big it's actually hard to wrap your head around, and it is all being bet on the promise of AI. $2.9 trillion. According to Morgan Stanley, that's how much corporations are expected to spend on AI infrastructure by 2028. I mean, just let that number sink in for a second. That is a truly massive, almost unprecedented amount of capital pouring into one single technological shift.
Yeah, so to give you an idea of how massive that is, we're talking about the entire economic output of the United Kingdom. We are basically betting an entire country's worth of money on the idea that these new systems are going to change everything for the better. The scale is just staggering. But it raises a really awkward question. What are we actually getting for all this money?
And this is where it all gets a little weird. This slide shows the central puzzle of the whole AI boom. On one side, you have AI investment just going vertical. I mean, it's a rocket ship to the moon. And on the other side, U.S. labor productivity, the very thing this technology is supposed to be supercharging, has completely flatlined. It's like we've spent a fortune on a Formula One race car, but it's just sitting in the garage idling.
And it gets even stranger when you look at the human side of things. We're pumping trillions of dollars into tech to make our economy more efficient, but at the same time, unemployment for recent college grads is spiking. So the people who just spent years and a ton of money learning how to be productive can't seem to find a spot in this new economy. It just doesn't add up.
So, if you're getting a weird sense of déjà vu right now, you are definitely not alone. This mix of insane hype, kind of shaky fundamentals, and a stock market that only seems to know one direction, up, has a lot of people thinking about another famous, or maybe infamous time in tech history.
So meet Michael Hartnett. He's the chief investment strategist at Bank of America. And his job is basically to be the adult in the room. He's the one who's paid to not drink the Kool-Aid. And in his weekly note to investors, which is kind of a reality check for the market, he is waving a giant red flag.
And look at the data Hartnett is pointing to. Since the market lows back in April, almost all of the gains in the entire S&P 500, we're talking a whopping 80%, have come from just 10 companies. You know them, the Magnificent Seven, plus a few of their buddies. And the other 490 companies in the index, well, they're just there. This isn't a healthy, broad market rally. It's a party being thrown by a tiny handful of AI darlings.
And the parallels to 1999, well, they start to look almost comical when you put them side by side. Back then, you just slapped a .com on your company name and your stock went to the moon. Today, you just have to whisper the letters AI on an earnings call, and poof, magic. The whole "this will change everything" promise, it's the exact same script we heard right before the last big tech bubble burst.
And here's the real kicker. This isn't just coming from some grumpy skeptic on the sidelines. This is Sam Altman, the CEO of OpenAI, the company at the absolute heart of the AI revolution. Even he is out there saying investors are sure excited. When the guy throwing the party is telling you the guests are getting a little too wild, you should probably pay attention.
And you can see that sure excitement right in the numbers. I mean, look at these valuations. They aren't just high, they're growing at a pace that is, to use a technical financial term, completely nuts. OpenAI's valuation could more than triple in under a year. Anthropic's has almost tripled in just 6 months. These are the kinds of hockey stick charts that practically define a speculative frenzy.
But hang on a second. Is it really that simple? Is this just 1999 all over again? Case closed? Well, the counter-argument is a pretty strong one. While the hype is absolutely real, the technology is also real. This time, there might actually be a fire underneath all that smoke.
Here's where that whole "it's just like 1999" argument really starts to fall apart. These companies are nothing like the Pets.coms of the world. Back then, the .com darlings were burning through cash with basically nothing but a catchy domain name.
The Magnificent Seven today, they're literal profit machines. These are some of the most successful businesses in human history, with billions in real revenue, massive cash flow, and huge defensible moats built on global infrastructure and mountains of data. They're not built on dreams. They're built on the digital bedrock of our entire economy.
And here's the other crucial difference. This isn't some promise about a far-off future. The AI revolution is already creating real tangible value right now. Just look at enterprise adoption. Microsoft's cloud business, Azure, is exploding because of demand for AI. That's real companies paying real money. Or think about your daily work. For millions of software developers, GitHub Copilot isn't just a cool toy, it's now an essential tool they use every single day. And it goes way beyond just code. AI is speeding up everything from discovering new drugs to creating content, turning years of research into months. This isn't theory, it's happening.
So, where does all this leave us? Well, the most convincing take seems to be that we're actually seeing both things happening at the same time. We're in a mini-bubble, a period of short-term froth and wild speculation, but it's all happening inside of a much bigger, much more legitimate, long-term technological revolution. A lot of today's high-flying startups are going to crash and burn, for sure, but the underlying tech, that's here to stay, and it's going to keep growing.
Okay, so if we're in this really tricky situation, part real, part bubble, how on earth do you know when the frothy part is about to pop? Well, instead of listening to your neighbor with the outdated browser, you should probably watch what the smart money is watching. And there's one key signal.
All right, the term is tech credit spreads. I know, it sounds super jargony and complicated, but stick with me, the idea is actually incredibly simple. It's basically the extra bit of interest that big, sophisticated investors demand to loan money to tech companies. It's a direct measurement of how risky they think the entire tech sector is at any given moment.
This is the perfect way to think about it. Imagine your friend comes to you with a business idea. At first, it sounds great, so you lend them some money at a low interest rate. But then their plan starts to sound a little crazier, a little more like a get-rich-quick scheme. You start to get nervous. So what do? You start charging them a higher interest rate to cover the risk that you might never see that cash again. That's exactly what credit spreads are for the big banks.
So here's what you need to watch for. When these spreads start to widen, meaning that extra interest rate starts going up, that's your signal. That is the smart money, the big lenders starting to get nervous. They're seeing more risk on the horizon. It's the canary in the coal mine. Or maybe a better way to put it, it's the financial world's version of your mom's intuition. You know, when she doesn't know exactly what's wrong, but she just knows something's up.
Now, there's one last indicator to keep in mind, and this one is more about psychology. According to a recent Bank of America survey, 60% of professional fund managers believe we are in a perfect Goldilocks scenario. You know, not too hot, not too cold, everything is just right for stocks to keep climbing higher.
And historically, that level of agreement among the pros is a massive red flag. It's what's known as a classic contrarian indicator. When almost everyone, especially the supposed experts, agrees that everything is perfect and nothing can go wrong, that's often the exact moment the market is at its peak. It's like showing up to a party and everyone is already dancing on the tables. Yeah, it might look fun for a second, but you know it's probably not going to end well.
So, we end here. There's no doubt that the AI revolution is real. But hey, the internet revolution was real too. That didn't stop it from creating a massive bubble that wiped people out. So the real question isn't if AI will change the world, it's when. And are the prices people are paying for these stocks today reflecting the reality of what these companies are worth now? Or are they reflecting the promise of what they might be worth, say, 10 years from now? That is the $2.9 trillion question.